This is a dialogue group, dialogue discussion between our ExCo members and stakeholders. And just for the background or history, we did this exercise during the annual conference until 2 years ago. And I hope you remember last year is the first occasion that we had this dialogue group during this global seminar, and we had a success. And we are sure that this have a bigger success because last year we did not have enough time for dialogue, so we allocate sufficient time today. And we have 3 sessions today, and as you have seen this morning, we have extensive discussion on ICS ComFrame, as well as this afternoon, ABA and systemic risk issue. So what we are going to do is allocate sufficient time and different people, IAIS leaders, executive committee members this side, and stakeholder this side, and discuss with the same subject. So first session, 45 minutes, we discuss on ICS ComFrame related issues. And then we turn to ABA, systemic risk, and the others, IAS activities issue, another 45 minutes. And then question and answer session, 30 minutes in addition. So first we discuss, panelists, both sides discuss together. And the last session, 30 minutes, we have sufficient time that you ask questions to audience, particularly this side. But if you want to ask your stakeholder, it's your choice. So my role is rather timekeeper and moderator, and this side chaired by our chairman, Vicky Saporta. So Vicky, please.
The panelists, my ExCo colleagues. We have Elise Liebers, who is on ExCo in her capacity as acting chair of the Financial Stability and Technical Committee, which is, of course, the committee that develops all our standards. Then we have Ted, who is the commissioner of Wisconsin and who sits on ExCo. Then we have Katie, whom you saw earlier on the same panel that I was moderating, who is the commissioner from Connecticut. Then we have Jonathan, who is going to be our next Secretary General. To replace Yoshi, who is abandoning us for pastures green after Kuala Lumpur, but who is actually now an ExCo in both his capacity as chair of the implementation committee, but also as a member of the relevant region. At the moment, he runs Prudential Insurance Supervision in South Africa. Then I have my vice chair on ExCo, Hiroshi, or Hiro, as I call him, Hiroshi Ota, who is responsible for international regulatory policy in the Japanese FSA. Then we have Michelle Fields, Michelle, the Superintendent of Insurance in the Insurance Commission of the Bahamas. And finally, we've got Frank, whom you also saw together with Katie and me earlier, who runs the supervision of the German insurance firms and who's on ExCo. Actually, I should say that the reason that we are missing certain of our EU colleagues on ExCo is because right now there's a board of supervisors in EIOPA that my colleague on ExCo, Gabriel Bernardino, has to chair, and some other of our colleagues had to go to. And Frank is sharing his time between this dialogue and having to rush over to Frankfurt, and he will be leaving us after the first part and some bit of the discussion. So thanks particularly to him that he's managing his diary to try to be in 2 places at the same time. On the panel, on my right-hand side, we've got Olav Jones, Deputy Director General, Economics and Finance from Insurance Europe. Well, actually, I'm not saying them with any order. Actually, closer is Sean McGovern, Chief Compliance Officer in Catlin, followed by Olav, followed by Michelle Rogers, Assistant VP, Internationally Regulatory Affairs, NAMIC. Then we have Tsuchuya Taniguchi, General Manager, Governor Relations, Daiichi Life. And then we have Peter Kochenburger, Deputy Director, Insurance Law Center, and Associate Clinical Professor of Law from the University of Connecticut School of Law. So with that, I'll pass on to Yoshi to moderate the panel.
Yes, thank you. So first question is just not from immediately or from this our stakeholders, but we receive comment on validation issue. This is very much related to our discussion this morning, discount rate issue, liability discount rate issue. Question is very important and very imminent question. So to finalize ICS 2.0, is it the only one discount option for MAB? That's first question. So you know MAB and GAP plus. So first question, there are a few questions related to each other. So first question is ICS version 2 valuation is only single MAB. Second question is, are there any plan what are the plans regarding comparability harmonization between MAB and GAP plus? Is it a plan to create a single valuation in ICS version 2.0, or it's a more longer-term ultimate goal? So that's a main question. So just to, Vicky, I hope that your part, or your sort of, our ExCo members answer this critical question for version 1 and version 2 discount, liability discount related question.
Yes, I understand that this question was a question asked by many of our stakeholders.
Yes.
So that is why we haven't asked one of the panelists. I believe all of the panelists want an answer to this question. I mean, to some extent, we touched upon some of this this morning. Can you hear me now? We touched upon it this morning. In terms of the aspired process regarding the development from ICS 1 to ICS 2, we have a commitment by all the members of our executive committee to deliver an ICS version 2.0 by 2019 that delivers what we have published already in terms of what it says. In terms of the key elephants in the room, to use the language that was used quite graphically earlier, it's all there. It may include 2 valuation approaches. It may not. Will we strive to have only 1 valuation approach? Yes, we will. Will we get there? I can't tell you because we have not finished the journey, but I can tell you that we shall certainly strive. How are we going to get there? There's another elephant in the room, which is internal models and also approaches to discounting. These elephants in the room actually are difficult issues, which actually make my job and the job of my executive committee members quite interesting. So I don't see them as elephants, I see them as challenges that make my life interesting and stimulating and worthwhile. And I'm sure that this is shared, but just to use the same graphic language to live, to make things a bit livelier. These are definitely issues that are all going to be discussed extensively. I mean, in terms of internal models, we are having a plan to develop internal models. In terms of valuation, I've already described. And in terms of discount approaches, we, as you know, we field testing this year under the MAV 3 approaches relative to the 6 that we have before. And the GAP Plus, we're now field testing only 1. This is going to give us lots and lots of useful information from September onwards to enable us to fulfill that journey. In terms of the process that we are going to follow for that journey, again, we touched upon it at least twice this morning. We are taking this process very, very seriously. That's why a subset of the ExCo committee members that is particularly devoted to the issue, which is usually members that have a number of internationally active insurance groups in the jurisdiction, or that are interested in developing locally a regime that is inspired by the process that we are developing, are the members of this task force. It's chaired by me, and it hopes to steer and provide advice to the whole of ExCo on resolving these more challenging issues that we just discussed. With that, I'll pass on to Elise, whose committee is doing all the heavy lifting.
Thanks, Vicky. Though I do think you touched on some of the highlights. When we talk about MAV, we did have, as you said, six options in the past. We had 3 this year. And the 3 that we had reflected both refinements of some of the ones that we had in the past, but also some new ones that were introduced by our stakeholders. Whether we can achieve a single MAV for version 2.0, well, we're certainly going to try to do that. That's a goal we'd like to achieve. I don't. In terms of having, just one accounting approach, I think that's probably going to be difficult to achieve in the time that we have. So I would imagine, and at least we're going to aspire to have one GAP approach and one MAV approach as we move forward in version 2.0. I don't know if there were, some more specific aspects we can touch on, in the questions, but, I definitely think we made, progress this year, and I think the steering committee that Vicky talked about is really going to help, because there have been some issues which the Financial Stability and Technical Committee have been discussing over and over again, and have divergent views. And so I think that the steering that we will get from the subgroup of ExCo members will really help us along, and I look forward to that.
So, yeah.
So I just have a question. What results from the field testing have you been getting about the differences between, the actual differences between a GAP plus approach and a MAV approach? And is there enough, is it material? Are the differences actually material?
The differences are material. Of course, this year in the field testing, we've asked for both the MAV approach and the GAP Plus approach, both to be tested using a high-quality asset portfolio. And we're hopeful by having both of them tested by the same portfolio that will help us perhaps, narrow the differences and identify, be in a better position to answer exactly the question that you're asking.
But I understand also that the discount, if we can converge this liability discount, that sort of convergence is much closer. Yeah,
discounting, of course, is an issue that is a major issue. Some of the standards, the accounting standard setters seem to indicate that they may be moving closer together, and if that happens, we think that that may close a significant gap that currently exists between GAP and Math Plus.
Shall we move? Okay, Olav.
Thank you. I think on, I guess a comment and then a question. I think from a European point of view, I think we're supportive of a MAV approach, but one that deals with your other objective, which is to avoid the short-term volatility. It does not cause a problem. And I think we'd also like to point out that within Europe, you know, we've worked a long time with Solvency II, and we've identified some issues which we have a review process to deal with, and we certainly do not want the ICS to repeat some of the same problems we see with Solvency II in terms of long-term valuation, volatility, and some overestimation of the liabilities. So I think on that one we're very active in providing input. But in terms of the two portfolios you mentioned, I think the one you mentioned you're going to look at high-quality portfolios. I think you've got to be very careful to not sort of make the mistake, as it were, to only test sort of under one condition, because one of the problems we've seen with the Solvency II process that we saw during the development was the problems arose when spreads increased. So if you test a high-quality portfolio now, but do not test how it reacts under the two different valuation approaches during, for example, a crisis, such as in 2007 with the corporate bond crisis, or 2011 with the sovereign bond crisis, you won't actually necessarily be testing properly the systems and how they need to work. So that's one question. Second question would be about the you have two methodologies, or you have a field testing methodology defined now, which and then you have another field test which is going to take place next year, and you have a sort of a feedback process by email, I understand. Will you be adapting the technical specifications for the next field testing based on that input, or do you currently plan to test with the same specifications next time?
This is 2018, next one, right? Yeah. Whoever with you, Elise?
Well, I mean, we would definitely take into account what we learned from the field testing. Otherwise, what's the point of field testing? And actually, you know, as to your first point about not just kind of looking at MAV and GAP Plus in a steady state, but also looking at how they might be comparable or diverge in sort of a more stressed event. I mean, that's a point well taken. I think one that the field testing working group is aware of. So,
yeah.
One more question. I was curious if in your field testing you are considering the differences and taking into account the differences between short-term contracts and long-term contracts, like the P&C agreements that are generally resolved in a year, the claims that are taken care of in a year, in your discounting research.
well, you know, I do think there's being, you know, a different approach for non-life and life, and you know, while the focus has been very significantly on the life side because the discount makes obviously a much bigger difference there, but you know, for the non-life, I definitely think there's it's a much simpler question, I believe, to answer and analyze. I don't think that's really where the issues lie in terms of the differences.
Okay, so just I think anyway this issue is continued to discuss. So just can we move to the next one? so anyway, this is another hot topic. Particularly, we received a lot of comments from industry, and this time, fortunately, Olav and Xian has lead that question in internal model, right?
Yes, thanks very much for having the chance to discuss these issues. In terms of internal models, I think I'll just kick off and then Sean will add some other points. But I think in terms of the European industry, internal models are a key element of the way many companies manage themselves and are a key part of our existing solvency regime. And in fact, our solvency regime was designed from the beginning to include internal models, and I think it would have been designed very differently and calibrated differently if internal models hadn't been included. So for us, the benefits of the internal models are very clear. They help identify and capture the potential risk classes by type, by region. And it ensures a harmonized regulatory framework. They help avoid arbitrary allocation of risks to certain classes, and they allow for alignment between the way the company manages risks in the best possible way and the regulatory approach. We don't really see any practical alternative to internal models because we can't see how a regulatory standard model can be designed sort of well enough to capture the wide variety of risks and companies that exist across Europe or indeed across the world. And therefore, the alternative would be an overly complex standard formula, which even then is unlikely to capture the full range of risks. So from our point of view, the internal model has to be an integral part, and we've been disappointed it hasn't been more fully included, but we appreciate that it's on the agenda in the future. So maybe could you help us understand better how internal models will be looked at and dealt with under the ICS regime?
And just before,
yeah. So thanks, Olav. I'll just add a few comments because I think it's important to reflect on the fact that this isn't an issue that's just of importance to European companies. We certainly believe, as XL Catlin, Bermuda-based specialty insurer, that internal models should be an intrinsic part of the ICS regime. We say that for a number of reasons. Firstly, we've been a field tester from the very outset, and we've actually seen through that process some positive change to the ICS regime, and I think that's proven to be a very useful exercise for the industry and for the IAIS. Having said that, the results from the last field test are just not results that we recognise. They don't give a close to a true view of our risk, and that may continue to change, and it may become more risk sensitive to our particular risk profile as we go through further field testing, but we still have a concern that it isn't necessarily going to be a true reflection of our risk profile. We heard in the panel this morning that one of the key roles for an ICS was to improve communication between supervisors to create a common language. I guess our observation would be that if you are already a group with a college, if you have a group internal model, then that can create the common language within the supervisory college in order to achieve the objectives that need to be achieved in terms of supervisory understanding. So we think an internal model can achieve some of the things that the IAIS is seeking to achieve in terms of consistency. As Olav said, in terms of understanding what the risk profile of a group is, if a group has invested the time in producing an internal model, it is how the group is viewing risk, it's how we set capital, it's how we deploy capital, it's how we manage our aggregation of risk, it's how we articulate our risk in our ORSAs. So why would we use something else as a measure of risk as part of a supervisory dialogue? At the moment, it's difficult for me to see, with the presence of an internal model, what additional value an ICS would add into that discussion. There was a question earlier about whether or not it was worth making the investment, if you like, on behalf of supervisors in understanding an internal model and the benefits of having a standard model ICS. I think the reality is if you've got a supervisory college and a group supervisor that has already made that investment and you have an approved group model, then again leverage that investment as much as possible and use that as the true supervisory tool for managing the risks within the group. So just to reflect on Olav's question, mine's more a statement of where we're coming from. I think, just to emphasise, I don't see that there's a lot of opposition from industry about having the option to use internal models if that is part of what the group wants to do. No one's saying everybody has to use them. But I guess the question is, will we see that optionality as part of the ICS framework going forward?
Totally clear question. So industry are very much hope that the internal model will be reflected. So.
Yes, Frank, would you like to take this question?
Yeah, thank you, Vicky. I would like to answer this question twofold. First, from IAIS perspective, it's very obvious that it's a complex issue, and developing ICS is very complex, and it's clear that not all issues can be addressed from the beginning, and so far we decided to a more sequential approach, and we took that into account in the ICS goals. There is mentioned that upon completion of ICS version 1.0, there will also be a plan to consider other methods of calculation of the ICS capital requirement, including the use of internal models, partial or full, or other variations of the standard model method, for example. So it's considered, it's addressed as an issue, but it's important to understand that we have on IAIS level an agreement and a commitment to develop a plan to consider how to proceed with this issue. That does not mean that we have a clear common understanding yet that the internal models will definitely be part of the ICS. That is the situation we are facing today. To this end, the 2017 field test will also collect both quantitative and qualitative information to support the assessment of the appropriateness of calibrations of risk charges covered by the standard methods, and to support the drafting of a plan to consider the future use of internal models. That is the situation we have now, and we have, as an ExCo, come to a conclusion and to a joint commitment on that issue. More I cannot say yet. I think it's encouraging that we can collect some information in the recent field testing, because, as you know, we are asking volunteer IIGs to provide data information specifically from their group-wide internal models about several technical details. That was the one part of my answer. The next part of my answer I would like to give as a German supervisor, who is responsible for some internal models as a home and a host supervisor on international groups. From my experience, or from our experience, we can say that we perceive companies supervised with internal models are the best supervised companies we have, because the intensity of the dialogue between supervisor and company we don't have in the standard formula, and there's a much better risk understanding, I think, from both sides, from companies and from supervisors. And so far, it's my personal view, I would like to see that the plan to consider the internal models will bring us to a clear path to use the internal models in the development of an ICS.
Frank, I mean, as Frank was very, very clear, this is, the second part of his question is very much, his own perspective, and as he was crystal clear, the IAIS perspective as a whole is not yet, we haven't yet reached a conclusion. We have just started, really, speeding up our journey towards ICS version 2.0. We were focused on delivering ICS version 1.0 for the time being. But if other members of the ExCo panel want to give an alternative perspective, please feel free. Elise?
Well, just to say that under the other methods, I mean, this is an area, internal models are obviously one aspect of that, but there are other things to consider as well. I'm sure we will have that conversation at the steering committee and at the financial stability committee as well. I mean, one of the trade-offs here, which we know well, is, comparability. So you have the risk sensitivity and the comparability, and of course, this notion of, talking the same language and making sure there's comparability across jurisdictions. I think internal models present some challenges in that regard. And so, anyway, we're open-minded to hear more and have that discussion. So stay tuned.
Yeah. So, okay. So anyway, I know that okay, very briefly, we have plenty of other questions, Peter.
I just wanted to ask one question. From the perspective of an attorney, I would also view each opportunity to communicate my internal model, whether initially, but also in supervisory college meetings, and also as an exercise in advocacy, and that's certainly what my clients would expect as an attorney. So how do you address that within, this constant meetings of pushback as to the appropriateness of a regulatory model? How do you address that throughout the process, particularly in supervisory colleges, but to make sure that the process of these models, internal models, don't become self-regulation to the exclusion of your oversight?
Frank, do you want to take the question as a supervisor, both home and host, of internal models at, yeah.
I'm not quite sure whether I understood the question right, but I try to make clear that the companies with internal models are the best supervised companies we have. I think there is no feature of an internal model which has not been discussed to a large extent with the companies. We send on-site and off-site our actuaries there discussing the features of the internal model. I think if you exchange views with large groups, you will, I think, get acceptance of that, what I'm saying. I think there is no danger at all of a self-regulation or whatever.
I mean, from my perspective, and now I'm taking off my hat as IAIS ExCo and put on my hat as a UK host. From our perspective, when we are supervising our own groups, both as home and as host, I mean, the way we have a long experience actually in supervising a capital adequacy using internal models, even before the introduction of Solvency II, since the beginning of the previous, since actually Equitable Life, this life insurance firm in the UK failed, we changed our regime and we accepted the use of internal models as an add-on to what was then the Solvency I regime in Europe as a Pillar 2 approach. We've met the Solvency I and then we use the model to add more capital actually. So, and the way that we do it is through a very intensive process of internal model approval. And then each time we go through, which is a very intensive process for both the firm and the supervisor, to make sure, as Frank said, that there's sufficient guardrails, that the modelling is appropriate, that the assumptions are appropriate. Also, as a supervisor, we have some information that is not available to the firms. We can compare modelling assumptions for the same risks across firms, because we see lots of firms. So that enables us to see whether a particular firm, where a particular firm lies in the range. We call them quantitative indicators. So if a firm is an outlier within the range, then we are going to be asking more searching questions. It doesn't mean that we will reject the model in that particular risk, but we're going to be asking more searching questions to see whether the profile is adequate. And clearly, as a host supervisor of firms that do allow, that at the home level allow internal models, we also engage in a very intensive process with our group supervisor in the supervisory colleges. It is an intensive process, as it was said in the morning. It is an intensive process. We also, in order to have more guardrails, use a provision within the framework that we currently operate, which is Solvency II, to collect information. I mean, according to Solvency II, firms need to maintain systems to calculate their capital adequacy under the standardized approach. So we collect this information and compare outcomes relative to the standardized approach, not because we think that the standardized approach is the right way to go, but as another check to check outliers, etc. So this is what we currently do to ensure that we are not gamed. But I have to admit, it is a very intensive process.
Okay, so I know that this is a very important subject, but we have we are considering very seriously. So that's the bottom line. So let's move on. Sorry, we have a few more questions and very mindful to the time. So next one, we received a lot of comments on this, not only from this panel, but other people. So the question is too much related to this morning question, qualitative, quantitative issues. So question here is how qualitative measures in the ComFrame will support quantitative measures like ICS in the context of ComFrame or ICS. So that's a question to our ExCo members.
Excuse me, may I add on this question?
Okay, yeah, of course.
Thank you.
Briefly.
Regulation have a power to change insurance business model. So that there are cases where the regulation affect their insurance products and investment, such as long-term product protection or infrastructure investment. So therefore, we should take into account this impact, such kind of impact, when we develop the international regulation. So, however, the current discussion focus too much on the ICS, especially ICS contents. So at the first place, usage of ICS is very important, should be decided in consideration of this impact. I mean the social and economical impact. So and then we can decide the contents of ICS. So I understand it is difficult to make a decision, usage of ICS without contents of ICS. But this is a kind of the chicken and egg problem. So but now we start the third field testing, and ICS version 0.1 will be issued soon. So this is a very good time to discuss of the usage of ICS. So the interaction with the whole regulatory framework, such as the ComFrame. So listening to today's panel discussion at the morning on the ComFrame, I'm wondering whether there is credibility among regulators. So I think most of qualitative framework is already included in the ComFrame and day-to-day regulatory practice. So what is insufficient in terms of the qualitative framework in this. This is another question. So therefore, I look forward to hearing answer to this question from the executive committee members. Thank you.
Thank you, Tetsuya.
Hiroshi would like to take this question from Mr. Taniguchi.
Okay, thank you very much for giving the opportunity to comment on that. First, taking this opportunity, let me just briefly review what the ComFrame is. As is well known, ComFrame is a set of international supervisory requirements, and it focuses on the effective group-wide supervision of internationally active insurance groups, so IAIGs. But at the base of ComFrame, there is the IAIS Insurance Core Principles, ICPs, which are the high-level requirements and guidance. And that's for all insurance companies. And back in 2010, IAIS began designing ComFrame, and in 2013, it marked the end of the development phase. The field testing of ComFrame started in 2014, and now it's still going on, and it will continue through 2019, when it is scheduled for formal adoption at the IAIS Annual General Meeting. So ComFrame will not only establish a comprehensive group-wide supervisory framework, but we think that it fosters a global convergence of IAIG regulatory and supervisory requirements. So as I said, ComFrame is being designed as a framework for the supervision of IAIGs, and it consists of both quantitative and qualitative supervisory requirements tailored to the complexity and international scope of IAIGs. The ICS is one of the components, of course, a major component of this comprehensive framework. And we think that ComFrame, through quantitative and qualitative measures, must have an integrated structure covering all elements of supervisory requirements to ensure its consistency and comprehensiveness. So for this reason, the IAIS will consider how to integrate the ICS into this comprehensive framework of ComFrame. In particular, the IAIS will consider how the ICS, which is being developed as a prescribed capital requirement, PCR for IAIGs, should be addressed in various parts of ComFrame, and it's particularly those relating to enterprise risk management, which includes, of course, the own risk and solvency assessment, ORSA, and the supervisory process and reporting. So the IAIS acknowledges the comments from stakeholders that there needs to be a balance between the qualitative and quantitative requirements for IAIGs. And we will explore this issue further as part of our consideration of how the ICS integrates with other parts of ComFrame. Thank you.
So shall we move on? I know that Michelle have some different questions, so just Michelle, this is the last one in this section.
Sure. Well, first of all, I want to respond to the answer that you just gave. I think that there is a question about overkill. You know, if we have the ORSAs, and the ORSAs are providing us some capital information that is either similar to internal models or similar to an economic model, are we not just kind of churning by adding an additional capital model that is required of all companies, that's very formulaic, that doesn't really fit everyone's particular system. It seems to me that what we've ended up with is a model that has too much optionality to be comparable between jurisdictions, and yet we're trying to insist that we fit everyone into the approach that we're designing, short of this optionality that might be allowed with internal models or that might be allowed with yield curves or other situations. And I just think that maybe a better focus on ORSA and a better focus on advancing the explanation and understanding of the ORSAs through the supervisory colleges might really be the better approach. I just throw that out there for your thought going forward.
Any thoughts on this particular issue? Ted?
Thank you, Vicki, and it's great to be here this afternoon. I do have a few thoughts on just the general topic of the ORSA. It was, you know, it was a process and a document meant to be fairly uniform in terms of, or fairly broad enough, I should say, to be filed with supervisors no matter what the jurisdiction. And one of the things I've noticed, and we talked a little bit about this the other day, is the fact that there seems to be a little bit of jurisdictional drift in the requirements around the ORSAs, and I've heard from some multi-jurisdictional companies that they're now filing multiple ORSAs with different jurisdictions, and that's not something that makes us as regulators look very good. We've got to be better in having our discussions when we all get together about, you know, holding the line on maintaining as much uniformity amongst different. Goodbye, Dr. Grund. Auf Wiedersehen, mein Herr. But we need to be better. And whether it's working on capital models or working on an ICS methodology, if we can't on an ORSA level, if we can't get our act together and just be good enough to accept a company ORSA as is without modifications, so that we're not putting these extra resource burdens on the companies we regulate, we've got a long way to go. And I promise you, as a fellow supervisor amongst all of us on the international side, that's something we need to do. We need to get our house in order and make sure we can deliver on just something, I would say, from a regulatory perspective, and it's difficult to put together, but something as simple as ORSA, before we go ahead and try to create a uniform, as we move along, I should say, and try to create a uniform way to measure along the lines of the ICS. So I hear you, Michelle, and I think it's something that we need to do better on, because I think the ORSA on its face is a tremendously helpful document from a regulatory perspective to really understand how companies are viewing risk. And it's a great tool for us as regulators when we get together, whether it's multi-jurisdictional in the supervisory college or just individually for our own analysis as to our comfort level and understanding of where companies are heading. Thank you.
It seems like to me that ORSA provides that basic information that you were all talking about with internal models, that it allows the regulator to get deep into the company's management thinking. It talks about how they reserve, how they manage their capital, what their issues are with how sensitive they are to their capital needs. And it involves a stress testing as well. So it does hit all of the elements that you're hoping to achieve. And it seems like that conversation with the companies and the supervisory colleges might provide the missing link that we're all looking for, because horses are already out there, and it might be a simple task to bring the laws of the world in line as far as horses are concerned.
And I just want to add just a comment just to completely agree with what the Commissioner just said, because, you know, we file about 19 ORSAs in different jurisdictions, and we just get pulled in different directions with comments. And so you end up trying to respond to, you know, what different regulators expect from the ORSA. We're trying to go through a group process of how we produce our ORSAs and how we view risk, and then cascading that down from group into the relevant legal entities. And that's very difficult to do. So there is a role for the supervisory colleges to try to, or for IAIS to try to drive some harmonization of how it is that companies use ORSAs, how companies produce ORSAs, and then how regulators want to use them, because it's becoming a real problem when it should be a useful tool.
Thank you very much. So I have to close this session here. We know that we have some more questions, but sorry, we cannot cover all. So please give big applause to this first session. So second session, stakeholder panelists, could you come to the stage, please?
So welcome to the panel. We've got with us Axel Welling, a member of the management board of the German Insurance Association. We've got George Brady, senior advisor and insurance lead of the International Institute of Finance. We've got Bernie Birnbaum, executive director of the Center for Economic Justice. We've got Jorge Claude, Executive Vice President, Association of Insurance of Chile. And we've got William McDonnell, Group Chief Risk Officer of the RSA Group. Thank you for being here. Yoshi, to you.
Yes, thank you. So this panel is focusing on ABA systemic risk issues. So a little bit the same issue, but different panelists and different angles. And theme is the same. So just to immediately give floor to Axel and George, I think that you have imminent question on this ABA and systemic risk.
Well, thank you, Yoshi. First, let me say it's a great pleasure to be here, and thanks for the invitation. When we looked at the activities-based approach and the work plan of the IAIS, we are quite positive about this. I think there's some promising thoughts on that, as it helps us to identify, probably if this is run through this exercise, much better those activities which are then really regarded systemic. I was a little bit puzzled between the difference between tsunami and domino effects, but maybe that will come. This will be clarified at a later stage. Promising. We find also the indications which were given this afternoon already with regard to mitigation techniques. That mitigation will be part of the designation process, will be regarded in that system. Also positive, and we think this is right, that there must be the interconnectedness being seen with the ICS process, that there's no double counting. On the other hand, we have a little bit the fear that at the end of the day, this designation process becomes even more complex at the end of the day. So what we see is that the activities-based approach is a good way, and we would like to ask you to think this through and maybe have an overall fresh start on with this, and not make an overall process in the designation, then with a combination of the company-specific approach and the activities-based approach, then even more complex as it has been in the past. And the question to ExCo is whether this is also part of the work plan, or whether we can already see now a kind of mixed approach for the future. George, would you like to supplement straight away, or?
No, I think that you touched on an important part of this initiative. The one is there's a big question around whether this is replace or complement, and I understood that it's maybe early in the process. I respect that perhaps it's maybe early to get an answer on that, but it would be good to understand a little bit more about how we got here. I mean, a specific question and a request is for a greater explanation, or maybe you can produce a report that was done towards the end of last year that sort of led you to the conclusion that this was the initiative. I understand that our future head, Jonathan Dixon, led a small group that examined this. And then related to that is also just ensuring that we have a clear connection with what systemic risk is. And I think to Axel's point, you know, to make sure that we look at this as a holistic evaluation of systemic risk in the sector, and not just sort of an additional initiative that's undertaken.
Hiro, do you want to say a few words?
Okay, sure. Thank you very much. But to be honest, I'm a bit embarrassed to make comments, because in the previous panel, our colleagues, Alberto, Stephen, and Elise, had made a very clear and rich presentation and comments. So what I can maybe do now is reiterate what they have said. The IAIS is still in the early stage of development of the activity-based approach, or ABA to be short. So with regard to the question of it being complementary to or a replacement for the entities-based approach, the answer depends on the future outcome of this ongoing project. So at this stage, we do not have any prejudgment. What we can say now is that it is clear that the two approaches, the entities-based one and the activity-based one, look at systemic risk from different angles. I'd like to reiterate what Alberto had explained in his previous panel. The key differences in approach can probably be explained by using domino versus tsunami analogies for the systemic risk transmission mechanisms. The domino view relates to the entities-based approach, and it focuses on the failure of individual insurers and their potential knock-on effects. Whereas the tsunami view, it relates to the activity-based approach, and it assesses how firms' activities, even if firms are solvent, may propagate or amplify shocks to the rest of the financial system and real economy via certain common exposures. So in other words, in an entity-based approach, the propagation of risk is assessed from the perspective of a failed institution, whereas in the case of an activity-based approach, the failure of an institution is not a prerequisite for risk propagation. But as I said, we are still in the early stage, and we are having a very frequently telephone and face-to-face meetings of the task force. and we are striving very hard to present you an interim consultation paper by the end of this year. Thank you.
George?
To follow up, I wondered regarding the research or the sort of the analysis that you've done to date, is this something that you're able to share now as far as what you've looked at? Because I still think in the spirit of dialogue, to better understand where you're continuing to see systemic risk in the sector. Do you consider the EBA, the entities-based approach, has effectively identified sources of systemic risk to support the continuing designation? That's sort of a separate question. And then I know we're early in the process of deciding then whether also an activities-based approach can either supplement or complement or whatever. But just specific to the EBA and also what analysis you've done on the work that's already taken place around G size.
Okay, thank you. With regards to the ABA, as Alberto explained in our previous panel, we are analyzing the concept of activities and also the concept of risk exposures. And we are trying to find out what would be the best way to capture the sources of systemic risk in terms of activity-based approach. So for the moment, I'm afraid that I can present you something very concrete, but as I said, it will be in our discussion paper, consultation paper, by the end of the year. So I hope that we can provide you something concrete, not yet a policy measure proposal, but still some finding that we would have done by the end of the year in the consultation paper. And with regard to the EBA, the revision of the EBA, of course, this is one of the tasks that the Systemic Risk Assessment Task Force must take. But so far, we are concentrated in the analysis of ABA, and we will sequentially will endeavor the analysis on the EBA probably next year.
If I could just jump in on this one, I wanted to just make a few quick points. The first was that to thank you for the work that you're proceeding on. This is really important. We think that the outline that you've set forth is really positive, and particularly like the fact that you're not prejudging any outcomes. You're not prejudging whether it's going to replace or complement the EBA. You're not prejudging any aspect of it. That's really important. It's particularly important that when you consider the mediation things, that you consider whether those mediation efforts, risk mediation efforts, are in fact the things that might be contributing to systemic risk. If insurance companies are all buying credit default swaps, does that create systemic risk as it did with the case of AIG? If insurance companies are buying hedges to basically protect themselves against the market guarantees that they've made, does that create systemic risk? So the fact that a company is engaged in some kind of risk mediation doesn't mean that they have eliminated the systemic risk. They've attempted to eliminate their company risk, but in the process they've created or may have created the systemic risk.
I think, Bernie, you have hit, you have described the difference between domino and tsunami in a much more eloquent way. So I think you're right. Just to make clear, we obviously have started this project. We have set out the timelines after the initial work that Jonathan undertook and his team undertook last year. But for the time being, both ourselves and the FSB have made clear that the ABA has been developing as a complementary approach to the entity-based approach. However, looking forward, depending on the work that we do, we obviously maintain an open mind. But this is the current position, the current stated position, and we haven't made any decision whatsoever to change the current position. We're just maintaining an open mind depending on what the findings are. Secondly, and this is just to be clear because of a comment Axel made, we have to distinguish identifying and measuring systemic risk, be it coming from the activities of many companies, or be it coming from the failure of a single company. The measurement, the identification and measurement of systemic risk is a different concept to what policies you might have to mitigate them. Of course, ultimately, the two need to be brought together. So what was said in the previous panel is, you first need to go into a very systematic way. The work that we had done on non-traditional, non-insurance activities, which we renamed last year, is a starting point of this, but we are developing. You identify the activities, and then you look at what policy measures you already have in place, and then you see whether there is any residual left. But this is the process that we are thinking about. So identification and policy mitigation are two different processes, but ultimately whether we need any additional policy measures will depend from this process, just to make clear the points that Alberto and his team were making today.
Yeah. Thank you, Vicky. So let's move on. So Jorge, so thank you for joining. I understand you have question emerging market and the ComFrame issue, right?
Thank you, Yossi, and thank you for the opportunity of being here. It's important for us to have the opportunity of talking about the concerns we have in emerging markets, what's going on with the ComFrame and what's going on with the, I would say, the whole regulatory framework. As you know, in Latin America, we don't have IAIGs groups. Of course, we have global insurance companies operating in our countries, but locally owned insurance companies we don't have. And I think in most of the countries that belong to IAIS, most of them don't have locally IAIGs. We find in Latin America what we call multilatinas. That means insurance companies owned by some investors, local investors, that operate in more than one country. They are expanding, and that's a process that's going on. And of course, we find local-owned insurance company, and they compete. And we don't see any specific, I would say, competitive advantage from one to the other. They compete. So my question, and I wonder if IAIS has specific initiatives to, I don't know if adapt or adopt ComFrame or some specific quantitative measures to reach the needs of emerging markets.
Hassan?
So thanks very much. Very good to be here and see a lot of familiar faces. Let me answer this question with an emerging markets hat on. And thank you very much for the question. I guess just a few initial remarks, which is, I guess, just bearing in mind, reiterating the message that the ComFrame work, particularly the ICS, we haven't set out to replace existing local legal entity measures. So it's not designed to be a model for supervision and regulation of local groups. It really is focused on internationally active groups. It's a group requirement on a consolidated basis that's expressed in the principles. And it really is designed to look at groups operating across multiple jurisdictions and help with the comparability of comparison. Now, that said, we have to think about, are there some spin-off benefits for the approaches to local risk-based solvency regimes? So first response is, and whether we can bring an emerging market perspective into that. And as a supervisor from an emerging market, it's something we talk quite a lot about in our ExCo discussions as well. So the first point is, in the process, we are in the field testing, trying as far as possible to be broad in the sample and to include field test volunteers from as many regions as possible. So for instance, there are 2 insurance groups from South Africa that are field testing volunteers and hopefully bringing some slightly different experience and perspectives to the discussion that's happening as part of field testing. But I think the other point from the perspective of what benefits can there be for supervision in emerging markets is that obviously ComFrame is aimed at increasing the efficiency of group-wide supervision, particularly in terms of cooperation and coordination amongst supervisors, including host supervisors, and easing the exchange of that information, including ICS, which hopefully provides a more comparability in understanding the financial soundness position of internationally active groups. And I think you pointed out a very important issue, which is that in many emerging markets, Chile being one of them, we have a number of internationally active insurance groups which are actually quite systemic in the local market in which they operate. So the operations in Chile or South Africa may be relatively small in terms of the group as a whole, but within those markets, that local business has serious systemic implications if there was a problem in the international group. And because of that factor, I think a mechanism to improve the involvement of local supervisors in the exchange of information, in the coordination of group supervision is particularly important. So that issue is being taken into account in the development of ComFrame, the importance of involving local host supervisors in any ComFrame approach. I think the other thing I would perhaps add, maybe this is a bit more of a personal perspective, is that perhaps there could be some indirect spin-off benefits from ComFrame and ICS, in that, as you will know, there are a number of emerging markets around the world that are busy with looking at their solvency frameworks, particularly trying to move to more risk-based solvency frameworks. But at the moment, that really is my experience happening in quite a disjointed way. Each is going through their own process, I guess, with potential of perhaps reinventing the wheel in each case. When they look around, talk from local experience, there are no, guidance at a global level is fairly limited. So the IAIS's work in this regard, as you know, is work in progress. So at the moment, that guidance would tend to be more regional models. Of course, some regional models have got a fair bit of prominence. But we have been thinking, particularly in the implementation committee, around the value that could come from the IAIS furthering this work, progressing this work on ComFrame and an ICS, if it provides a framework for thinking about risk-based solvency systems. And if you could take that framework and develop guidance or find ways to apply it in a proportionate way that is commensurate with the nature of the local market, the nature of skills, including actuarial skills in those markets, this would, I think, have a spin-off benefit in terms of helping to facilitate or promote some convergence in risk-based solvency systems around the world, which would in turn have, I think, considerable benefits in terms of insurance market development in those jurisdictions and promoting trade across borders as well. So, it's not something we think a lot about in terms of ComFrame and ICS, but I do think there are interesting things to explore there. Thank you.
Thank you, Jonathan.
Yoshi, can I follow up? Can I just real briefly? I mean, these are the kinds of discussions, not necessarily directly to your question about ComFrame, but these are discussions that I enjoy having with my fellow supervisors about remembering the rest of the membership of the IAIS, who include many from developing and countries developing regulatory systems, and that this organization, the IAIS, with lots of brain power from lots of different jurisdictions and lots of resources, who can get together and work with developing countries and help them as they develop their regulatory regimes and be a resource for them. And I know Yoshi's been participated in a lot of different venues across the globe, helping out different developing markets, and as well as many of the members here. And there's nothing more satisfying than working with a fellow regulator to help them kind of get to the next level or achieve some success. So I think we spend all this time, very importantly, working on the ICS and the ComFrame and all of these other things for certain jurisdictions, but we can't, as an organization, forget about the rest of our membership, who is relying on the IAIS as a regulatory support organization. So that's very key. It's a great question, and it sort of goes to the heart of some of the other things we're doing when we're not working on ICS and valuation and other things.
Yeah, extremely thanks. Yeah, we tend to forget that importance and how much we regulators allocate for dialogue with the emerging market, as Jorge knows, and many of you might know that and Ted, Vicky, of course, Jonathan, and many of us here spend a lot of time to dialogue and to encourage emerging market to catch up and to work together with other regulators. And that's a huge important foundation of the association. And of course, as Jonathan clearly mentioned, this ICS initiative also helps, and to some extent systemic initiative helps the emerging market to enhance their regulatory schemes. And definitely it's a very important mandate for the association.
I'd like to make a suggestion that one way that some of the more developed markets can assist the emerging markets is to help ensure that the emerging markets don't encounter the same abuses with credit-related insurance markets that the developed economies have. If you look at the US, Australia, the UK, even of course in South Africa, the abuses in the sales of consumer credit-related insurance or payment protection insurance have been massive and rampant. So that would be one really good place to start in terms of helping developing economies avoid those same problems.
Thanks, Bernie, very much for that comment. And I might use this as an opportunity to advertise a bit that there is an application paper coming out which deals with product oversight in support of inclusive insurance markets, which I think we discussed on Wednesday some of the issues around that, and Credit Life was actually used as an example in that discussion. So I think point well taken, and we are hoping through this application guidance to bring this to the attention of our broader membership. Thanks.
Yeah, thank you. So let's move on. So one question is also, I think quite few stakeholders ask question is related to fintech innovation issue. And that's a quite interesting question. What type of innovation in insurance do you see as desirable? You mean the regulators desirable? And what type of innovation regulators see undesirable? And what the regulator would like to promote innovation of desirable, innovation. So maybe, yes, William, could you add? Yeah.
Yes, and I might just flesh this out with a few just thoughts, examples of things. So 5 different sorts of innovations that on the whole are great things and we as participants very much want to see, but which do have a downside potentially as well. So one of them is the gradual simplification of sales processes, which many customers want. But again, there's the challenge of, does the customer then understand the product? How do you get the complexities across? Who reads terms and conditions? Automation, terrific thing in terms of productivity, efficiency, bringing down the costs, and also can improve controls, but checks and oversight to prevent rogue algorithms and that sort of thing. Interactive products and approaches to customers. We had one example recently where we introduced automatic approval of motor damage claims within certain criteria. And we found that we actually had a huge spike in calls to our call center. The reason is the customers didn't believe it when within 1 minute their claim was approved. We've now built in a 20-minute delay before. Another one, of course, is big data, but then potential social exclusion, things that can arise, or do you force insurers to write uneconomic contracts, and there's prudential aspects to that. And the 5th one I had in mind was changes to distribution. And markets obviously evolve. The danger is if you have potentially blurring of carrier and distributor, and possible real concentrations of data and technical knowledge in a distributor, and then potential greater risk of future disruption that could create. Anyway, I throw those out as just to give a bit of colour to the question.
Thank you, William.
Thank you, Madam Chair. Obviously, this is something very near and dear to my heart. It's an area where the U.S. Regulatory system is undergoing a full year immersion in this continual journey to understand and continue to better get a handle on the ever-changing world of innovation and technology. In addition to that, we spent a lot of time at the IAIS working on and trying to understand the areas of innovation and technology. I think all of us as regulators are somewhere between in the dark and particularly curious about how all of the changes that are going on, that some of them were just discussed. It's a goal of the IAIS to make sure that our membership remains engaged on the areas of innovation and technology as they continue to evolve, and making sure we stay ahead of those changes. I think I sort of summarize. I'll start with the summary first. I'm supportive. You know, the question is, what would you be supportive of? And I'm not going to say I'm supportive of company A or product B or innovation C, but really it's. I think any regulator is supportive of innovation and technology, which provides greater access to better designed products and service meeting consumer needs. I mean, that's what we ultimately want to see. It's how do we get there, and how as regulators do we keep up with a lot of the change. And I think there's a couple ways to do it. One is to continue to interact with companies who are engaging in obtaining, developing, acquiring different types of technology that essentially, in a lot of cases, and this goes to the sort of the delivery channel piece, meet the changing needs of consumers. My kids wouldn't necessarily want to buy insurance whenever they start buying it the way I would. And I think you're seeing changes in consumer behavior, consumer demands, and insurers are trying to meet those demands. And then there's a regulatory framework that can at times be a bit rigid, and it hasn't kept up with the changes in technology and changes into products and delivery systems. So it's a continuing battle and an opportunity for regulators to think about ways to make or amend or update their regulatory framework to perhaps be a little bit more principles-based, to take into account a lot of the innovation and the changes going on out there, and not be quite as rigid and as difficult to deal with. But in order for all of us to work, we all need to work together. The companies need to talk to and show and help consumer representatives like Bernie and others what they're doing and how they're doing it. Regulators need to be talking to companies about what they're proposing and how their business models are changing. We all, from the regulatory side, need to be more, and I think we are coming around to the idea of innovation hubs and sandbox arrangements where products can be tested in a fairly safe way that won't harm consumers, at least not during the testing process, so we can understand that they're not. Black boxes need to be opened up. We've got to understand that these great ideas that we as regulators are presented with that says, well, we're going to get a great deal for all your consumers. Well, somebody's not. And we got to understand that the way the technology is being used is not being discriminatory or unfair to consumers. It's got to be based on existing underwriting and rating kind of standards. So we've got a lot to do, and we've all got to be a lot more open-minded and understand that if we don't embrace and understand the technology and the innovation that's coming, we'll never be able to even come anywhere near advocating for some desirable innovation. I think we've all got to get to a point where we're all working together. We all understand, and obviously there's trade secrets and special things like that can be dealt with. But we've got to understand the process and the analytics and the way the data is being used at the end of the day, so that consumers ultimately aren't being harmed. They're being provided products at a good price, meeting their needs, but we're making sure that people aren't being taken advantage of. And it's a very difficult thing because the technology is so complicated at times, but we should be working together on that.
And I mean, I think that's absolutely right. And in addition, for myself as a chief risk officer within the group, I need to know that as we engage with these innovations, that my colleagues have understood, really thought through the risks, what's different, and then how to adapt the controls and the governance approach in an appropriate way to it. But that requires early engagement, dialogue, and so on, which is what we do and what we seek to do. But thinking carefully how to adapt the existing risk and control and governance approaches to the innovations is absolutely crucial.
So I'd like to follow up on that one too, which is that I think it's kind of clear right now what the possible futures of insurance are. I think on the one hand, the big data has the opportunity to empower consumers and businesses so that the future of insurance is basically consumers and businesses partnering with risk management and sustainability companies who also happen to sell insurance. And that consumers are empowered in a way that they've never been before in terms of understanding the products and being able to evaluate the performance of companies, being able to get products that meet their needs. Then there's another future, and that's a future that is dominated by black box algorithms, where you basically are channeled when you do a Google search to a particular vendor or a particular company based upon who the operating system is, or you're channeled because of some big data algorithm based on credit history or education, occupation, web browsing, or something like that, that you never see, that your application is pre-filled. So that future is one where it's completely opaque to the consumer and it doesn't fulfill the sort of the loss mitigation or loss incentive opportunities for insurance. So I guess our view is that regulators and policymakers should be saying, we clearly prefer the former. We don't want a system that is simply opaque algorithms where consumers have less and less market power and less oversight, and there's less and less incentives for loss mitigation. So when you look in that lens and you're evaluating a particular technology or a tool, some tools make the former possible, or some tools make it impossible. So if you're not going to stop companies from using all sorts of big data in an unlimited way without any accountability to a consumer, you're never going to get to that former vision of the future. So that's why I guess our view is that it's important to sort of stake out what you want to see insurance look like in 10 years so that you have some roadmap to guide you when you look at innovation.
Interesting. Yeah, thank you. That's how do we make best use of the data, not discriminate, for example, of consumers is critically important issue. But do you have any comment?
I couldn't agree more. I really couldn't agree more. And you make the case very clearly. And from a consumer standpoint, rewarding good behavior by, participating in the Internet of Things and arming your house and putting different sensors in and buying cars that have accident avoidance systems should be rewarded. And in terms of products that meet needs versus being unlucky because you looked at the wrong website one day when you're on your lunch break, and that gets caught into an algorithm which somehow deems you as a risk and something you'll never even know about. So I'm with you, Bernie, on that one.
Yeah. Jonathan?
Yeah, if I may add very briefly as well. Bernie, I think you put it excellently. I mean, these are issues that we have started, obviously, as supervisors to talk about as well. It's early days, but one very concrete step that we've agreed yesterday was to establish a dedicated capacity to start collectively dealing with and tackling some of these questions. I mean, the type of conduct risks that you refer to are new. It's still a conduct risk, but it's coming in different forms, and finding a way to move towards an outcome that we want on the conduct side is going to take a lot of careful thought. So we are going to put together some dedicated capacity to deal with that, recognizing that these may be people, these may be individuals who are not your traditional Prudential supervisors, who are, your accountants or your actuaries. These will be people within authorities who are dealing with financial innovation issues and can, from various authorities, various jurisdictions, who we want to bring together as a sort of virtual think tank to start tackling these questions.
I remember that, I think, Jonathan, you mentioned that Zimbabwe, 1.8 million people lost one day immediately, one day just because of this, huge, massive selling by digital-related selling, and this company did not provide service anymore. So that's a kind of impact that we are very much worried about or concerned through this, misuse or long use of this digital technology or some, internet-related one. But
so one quick follow-up, which is, I think this extends also on to the Prudential side, because a lot of these new technologies aren't just specialist data scientists creating an algorithm. A lot of them are now based on machine learning, where once the algorithm is started, the algorithm teaches itself. And when you get into a machine learning environment, I think that not only has implications for conduct of business risk, but it's also now moving into the Prudential side.
And again, if I could just comment on that, I think there's two aspects that I think about. One is, when you have machine learning, to what extent is there checking and oversight of it? But the other one is, how do you retain the staff technical knowledge so that you can spot if something goes wrong, or you can take over if you need to switch off the algorithm? And that certainly internally, that's something we think about a lot.
Thank you. So I wonder, that's excellent comment, that we should work together how to do this kind of issue. But just, I'm cautious of the time, so we still have 15 minutes for Q&A. So just, if you don't mind, just I want to open a floor. So today we cover not only ICS, ComFrame ICPs, but of course ABA, and also our emerging market issue and various issues. So this is unique opportunity for audience stakeholders, particularly to ask any questions to our leaders of the association, ExCo members. So Steve, are you ready? So just follow. Sorry, just so could you call that first, and then sorry, I could not see that.
I pay his salary.
Yeah, okay. So you go first, and Steve then follow. Yes.
Scott Gillen with Cincinnati Financial, a Fortune 500 insurer located in the United States. Although my company does not yet operate internationally, we cannot rule out future growth in the international sector. So public policy debates in the international regulatory space do matter to us. We think the U.S. has one of the most robust, rigorous, and well-tested insurance regulatory regimes in the world. And I'm sure many other jurisdictions feel the same way about their current regimes. We acknowledge the regulatory challenges posed by the global nature of the insurance marketplace, but with all due respect to the IAIS, we are very concerned that our U.S. regulatory system is being threatened by the IAIS emphasis on promulgating new global insurance regulatory standards. So I have two questions for the ExCo, which I ask with the best of intentions. First, the Executive Committee Chair told us this morning that it is up to each jurisdiction whether to implement any of the global standards the IAIS promulgates. How would the IAIS react if a jurisdiction refused to adopt IAIS global standards in order to keep its already well-functioning regulatory system in place? And second, has the IAIS ever considered taking on the role of an international regulatory coordinator, a regulatory translator of sorts, with a focus on getting the different jurisdictional regimes to converse with one another, understand each other's regimes, and focus on cooperation instead of simply acting as the promulgator of new standards, which each country is asked to adopt to replace their own existing standards, even when their own regulatory systems are still working well?
Perhaps I can start and then my colleagues can chip in. Thank you for that question. For these questions, actually. First, to clarify, of course, the ComFrame, which will include the quantitative element, which is the capital standard, only applies to very large globally active firms. So it is not proposing to touch the purely domestic firms or domestic firms with very small activities abroad, just to be clear that this is the distinction we are making. Secondly, direct answer to your question, what would happen if we adopt a particular standard? And we adopt many standards. I mean, the insurance core principles are standards that we have adopted in developments, and a jurisdiction chooses to have a regime that is not compliant with these standards. We obviously are not an enforcer. All we do is we do peer reviews. At the moment, just to describe what we do with our insurance core principles, we'd have a self-assessment peer review process where supervisors give us a self-assessment which we look at on whether they comply with the insurance core principles. We also have issued, completely on the other space, GSII policy measures since 2013 and 14, when we started the identification process for our GSIIs. These policy measures are not capital related, they're related, they have to do about systemic risk plans, liquidity risk plans, and the setting up of crisis management colleges. We are going to we have initiated a self-assessment of how the jurisdictions that have GSIIs are actually adopting those, and we're going to do a peer review process. So once we have adopted in 2019 ComFrame and ICS version 2.0, I expect that we will develop a similar approach. And that is how we will react. You know, we usually, I mean, these peer reviews are pretty transparent. So a jurisdiction will know that that they do not comply with our particular standards, but there's no other consequence whatsoever. Having said that, the process by which we adopt a standards is a consensual process. We do have voting mechanisms within the IAIS, but we strive for consensus. So the hope is that by the time that we reach these agreements, these are accepted by the supervisors around the table. And that's it, but that's the process. In terms of whether we have considered the importance of international regulatory cooperation, of course we have. Indeed, as part of our ICPs, we have particular ICPs that focus for many years now on how to develop exchange of information, of confidential information in a secure way. We have a process by which we facilitate within the IAIS the signing of memorandum of understandings between our supervisors to actually facilitate this exchange of supervision. We have ICPs that talk about supervisory cooperation that goes beyond the exchange of information. And we are updating those in relation to ComFrame. Indeed, this morning you got some information about how we are doing that. So exchange of information and supervisory cooperation is also at the core of what we do. But that does not mean that we will always be adopting standards that are automatically, every jurisdiction is currently compliant with. We are trying to come to a process where the standard is one that we arrived through consensus and we agree. Some jurisdictions might not be meeting it currently. I'm not talking about your jurisdiction in particular, but some might not. That's fine. Hopefully they have come to the table and they have agreed it because they have a plan in the future to adopt it. If they do not, this is their choice. We will do a peer review and we will assess them through that way. I don't know whether ExCo members have.
So Vicky, thank you for for the very good explanation of the work. I think from a U.S. perspective, this is why we're here. We spend an enormous amount of time trying to work with our colleagues across the globe, explaining how our systems are different and how can we come together. And these are challenging at times, and we have very different systems, but we are committed to trying to work through the issues and continue the dialogue so that we can. We talked earlier. People have talked at various points about outcomes-based approach, and we may get there different ways. But as long as we understand how the different systems work, and that we can get to the same place, but not necessarily the same way. And we're committed to continuing that dialogue and work.
Thank you. So,
thank you very much, Katie.
Yeah. Okay. So let's move to Steve.
Thank you all very much. Steve Brody from the Property Casualty Insurers Association of America. We appreciate the opportunity to have dialogue with you today, sort of the extended panels that you've had, the opportunities to ask questions during all the sessions, and that we'll have tomorrow. I want to ask a couple of questions that have to do with increased stakeholder participation, which is something that we've always supported, and we appreciate the steps you've made in this direction. One is with respect to the ICS. As the development of ICS 2.0 continues or starts after the field testing process, we think that one thing that helped in developing 1.0, getting to where we are, was the fairly frequent sessions that were held with stakeholders during that discussion. And we'd like to ask whether there are any intentions to doing something similar to that with stakeholders as 2.0 is developed. We'd strongly encourage that. And I guess the second thing that I would like to, the second question that I'd like to ask, or request that I'd like to make, is that consideration be given to bringing stakeholders into the working group process, perhaps on a limited basis, perhaps on a 1 meeting per year basis or 1 session per year, that would help us more to understand the issues you're dealing with and the, sort of the, the thoughts that you bring to the table. That helps us immensely when we respond to consultations, because sometimes you may get answers from us that seem a little bit off track, and part of it is because we don't know exactly where you're coming from. And so we don't know how best to respond to the issues that you're raising. Some working groups have moved a little bit in this direction. We'd like to ask that this be continued, and suggest that one way to do it would be to have 1 open meeting with working groups during the year.
Thank you. These are 2 different questions. Elise, do you want to take the first one?
Well, in terms of the development of 2.0 and engaging stakeholders, I mean, that's clearly we would want to get input from the stakeholders. One of the things I think you heard Paulo express this morning is a little bit of somewhat of timing issues in terms of trying to get our work done, and at the same time make sure that we're receiving your input and that it's having value as we make our decisions. I have to say that from my observation this year, when I look at the CSFWG, the working group that works on capital, they have had so much engagement, given their workload, quite frankly, with traveling to different parts of the world to engage with the stakeholders. I know that that's particularly true with the volunteers, and I take your point that you'd like that to be expanded beyond the volunteers and have more engagement, and we can certainly take that under advisement, but it's not it's not a desire not to engage. We want to engage. It's a matter of trying to get all these people to, finding the right forum for that engagement.
Yeah, and if I could add, Steve, we discussed this issue quite a lot, and one issue particularly to relate to your second question, what we do now is, for example, this occasion, in the morning we discuss not only ICS, but ICPs, like a governance issue and a group issue and other issues. And tomorrow we discuss market conduct issue. And this is very timely because just consultation has finished, and how do we resolve it? And as we do now is once we decided to develop some standards, we communicate intention, receive comments, and once we receive comments, we invite conference call and dialogue with us. And naturally, our emerging market members also want to know what we are going to do, and Jonathan and others take a lot of initiative. So we try to find limited resources as effective as possible, communicate with you and stakeholders. And this is also, of course, some groups, in addition to Capital Group, if there is an occasion to have an open dialogue with stakeholders, but we do not make it a rule or just standards that every committee should do it. But we try our best to communicate with you in a timely manner so that your input is well reflected in our work stream. Yes, please.
Good afternoon. I'm Leila Medeiros from the Association of Bermuda Insurers and Reinsurers. I want to thank you and Victoria, your opening remarks this morning about the objectives, and I think we've made a huge step towards that increased transparency. I've also enjoyed the candor this afternoon with the executive committee and the recognition that there are so many issues and moving parts. And I was thinking about the activity-based. There's a whole bunch of stuff that's going on, whether it's emerging markets, and I think it's interesting to have this sort of contextual view. I'd like to raise, in the sort of the context of the development of these capital standards, that we have to consider the trends around the globe that we're seeing in protectionism, both regulatory and tax, to the benefits that are being or could be damaging to the benefits of global pooling of reinsurance, which has served policyholders well. And I think there's some studies and academia out there that have identified at least 24 countries that have imposed some form of protectionism through their regulatory platform, either limiting cedents, a percentage of how much they can reinsure externally, et cetera. And I think that we have to take an honest look at sort of how we can better understand the implications of that protectionism and what it means going forward. I think sometimes regulatory protectionism can offer sort of this security blanket. But there's a recent study that was published, it was either last week, I believe it was last week, that shows that diversification is key to keeping down the amount of capital needed to service, especially catastrophe risk. And the example cited is that the global capital that would be needed to cover US and non-US catastrophes would have to be increased by $70 billion, or a 40% increase to cover the $247 billion in the event, for example, that the US would adopt a tax protectionism measure against reinsurance. So I'd like to ask the IAC, this is an issue that is not sort of, I think, going to go away. I think it may actually increase. We've seen that trend. And will you sort of look, I know, I applaud the IAS. I see there's a change in your current consultation to ICP 13 to include a reference to the importance of global diversification in the financial stability of reinsurance. And I'm just asking the question, does the IAS intend to look at this macro issue further?
The answer is that amongst our, we recognize the issue. We are a global standard setter, and clearly in doing so, we're looking to create safe and stable markets that protect policyholders. And within that, diversification is clearly, it's the insurance business, and diversification is something that is very important in the creation of these markets. However, we need to focus, particularly because of our very, as you saw, challenging but stimulating agenda and goals that we absolutely have to deliver in standard setting space over the next couple of years on what we absolutely have to deliver, which, as you have heard, continues to be ComFrame ICPs, ComFrame within it ICS, ICPs so that they get integrated on standard setting work, complete the work program on activities-based approach and GSII, ensure implementation and ensure capacity building and assessment on emerging, on the emerging market side. So these are our priorities overall. Within that, we do not at this moment have in our roadmap a plan to produce sort of the research or analysis on the macro issues. To some extent, they're relevant to what we do, but we are not, they're more relevant, I'd argue, either to authorities that they're more core to the mission of authorities that, international authorities that look at barriers to capital flows and what these could create, and also to some extent to authorities that look at development and ensuring sustainable insurance markets. So rather than the IAIS, which is a standard setting mainly body. So within our remit, we will do what we can, but we don't have, at the moment, given everything else we have to do, a plan to do further research.
And just one word, so just to, assuming that all regulators speak the same language, common language, we trust much, much more each other well, and home and host work extremely well. So there is no reason, that we have a barrier. For example, capital should be domiciled and so on. People trust, and the capital should be moved on. That's a kind of spirit that we have it, but it's not our mandate to prevent that one. But at least visionary, if we create a common language, we trust each other, regulators trust each other, we create a community among supervisors where internationally active companies can operate much freely. That will lead to the politician, hopefully, that they understand that free market is excellent and they should move to the free market, free economy. So that's a spirit that we have it.
Jonathan?
Thanks, Vicky. I just wanted to add, to reiterate what Vicky said, that this is there's not envisaged to be a dedicated work stream on this, but that doesn't mean to say it might not be touched on by some existing work streams. So there is macro-prudential surveillance activities that we conduct that may touch on this. The other thing to mention is that we are increasingly placing a focus on supervisory practices and exchange of, peer-to-peer exchange around good supervisory practices. And a particular focus recently has actually been on reinsurance and supervisory practices around reinsurance. And we expect that work to continue. And in fact, we expect that focus to grow over time in support of implementation of our standards. And so without prejudging, I would imagine this is the type of issue that might come up in discussions on supervisory practices in reinsurance.
Thank you. Well, so thank you very much. We are just over time, and we know that we have excellent cocktail tonight. So if everybody agrees, we just give excellent panelists, give a big applause for this.